So we just kind of spelled out a bunch of big name investors. They're seeing opportunities in China. At the same time, we laid out some of the big macro factors, slower than expected growth, slower than expected consumer spending, high unemployment, et cetera. What's your view on Chinese equities in the short term? Is the Fed rate cut, is that a catalyst for that market?
Yeah, it's very clear that China economy is grappling with this prolonged cyclical downturn, which was driven by the historical low consumer and business confidence. Therefore, in the near term, in order for the Chinese equities to work, I do think we need to see meaningful and effective policies to support domestic consumption and demand. And without that, I think the downward spiral on the deflationary side will continue. Having said that, I do think the valuation of Chinese equities has gotten more attractive. I think it's close to all-time low. And with MSCI China, I think traded at the 8 times forward PE. So with that, I think there could be opportunistic investors start to look at this asset class to see whether we can position accordingly and to capture a certain upside. But unknown to me is about the timing and magnitude of the policies. Without those, I think it would be hard to see that rally.
So very quickly, I want to point out the fact we're showing the charts right now. We're seeing a lot of Chinese equities popping right now. I'm looking at JD.com, down 1% for the year, but right now in the pre-market up 6.5%. Very similar story for Alibaba, popping right now in the pre-market. So I just want to touch on that action that we're seeing right now. What do you think the catalyst is for that action? Is it simply like you're saying, it's an attractive valuation? We're seeing the Fed rate cuts. People are seeing opportunities with these stocks, not trading at lows, but certainly trading lower than they have before. Is that what we're seeing in the pre-market today?
Yeah, I think there are 2 aspects to that to support those stocks rally. Number one, I think it was about the top-down perspective. Weaker dollar tend to lead to better emerging markets kind of performance. So China's one of the biggest emerging markets, which has been lagging. So it's not surprising people can look for the opportunities there. On the other hand, I do think those companies tend to be the bigger, most liquid companies within Chinese equities, especially widely accessible to global investors. Therefore, you get additional attention there. And last piece I want to mention is that the fundamentals of those companies have improved in recent times, which part of the early recovery of those consumer demand and eased competition within the e-commerce space.
Okay. Like we said, the quote-unquote smart money is putting more money into China right now. But it sounds like you said without that quote-unquote bazooka stimulus, seems like that's what you were alluding to, that you don't see a really attractive setup. How long do you see Chinese equities under pressure? What potentially could be a catalyst for a longer-term turnaround?
Absolutely. So we've been through this back and forth several times in the last 2-3 years. And therefore, I think we tend to be careful about getting into this asset class again. If without seeing meaningful policy stimulus, without seeing the improvement of the macro fundamentals and the corporate fundamentals, I doubt the duration of the rally and also magnitude of the rally. So as I mentioned earlier, in order for this equity asset class to work, you do have to break that downward spiral of confidence-led and deflationary pleasure. So before that, I think it's difficult. So that's why policy is super important, and we're watching the space very closely.
You know, one last question, Vivian. A number of big banks actually lowered their growth forecast for China. Citi, Goldman, and Bank of America all lowering their previous forecast. Very slightly, though. China put out their own growth forecast of 5%. Is that really a big deal? I mean, I'm looking at Citi, it's 4.8. I'm looking at Goldman at 4.7. Also Goldman at 4.7. Still very close to 5%. Why isn't that good enough?
The headline GDP growth of China has not been a very good indicator about the underlying health of the economy or the corporate earnings for some time. So there's a decoupling from there. And one of the reasons is that part of the GDP growth in recent couple of years was primarily driven by exports. Therefore, it may not really benefit a lot of companies directly. And we know that with the rising geopolitical risks and increased tariff discussion by EU or the US, this exports-led growth could be also under challenge. So therefore, even though the revision down isn't very high, but I think the impact on the corporate earnings could be more meaningful